Now in this tutorial, what I want to do is go over the estimated buyer's costs. So again, this form is filled out when you are working with the buyer. And what I'm going to do is I'm going to be changing a couple of the figures in here as we go along so that we get everything sort of balanced so that I can show you how we would just change some numbers around. So again, what we have here is we have the name of the buyers, we have the date, and the date is what everything is based on, this particular date here. We have the property address. We have the estimated closing date of the transaction. Remember, the estimated closing date is created or based on the fact of when the purchaser, the buyer, makes their offer and the offer is finally accepted by the seller, and in that offer they accept the date that they want escrow to close. So that's where we're getting this number from. I am going to go in here and change one number that I needed to do on the buyer's costs. I'm going to change this because we're assuming that the buyer is actually going to go ahead in here and pay a little, wants to offer a little bit less for the property. So that's where we're getting this number from. And let me go ahead and just click on any box to get that to accept. So they're going to make an offer of $450,000. Next thing that I want to do is, let me move this little thing down here so we get rid of this up here. Again, the projected closing date, we've talked about that. The new buyer is going to get a loan for $360,000. They believe they're going to have an interest rate of 5%. It's going to be fixed, and it's going to last for 30 years. They're not going to have a second loan. And their current property taxes, remember in California, that when we sell a home, that triggers an event where it gets reassessed. So the new property taxes for the buyer are going to be higher if the real estate market has been going up in value. They're going to be higher than they were for the seller. Okay, and that's going to be based on the sales price of the home. So anyway, we're putting, instead of an amount in here, we're putting a percentage in here. Okay, and again, by default, California is 1% of the sales price. And remember, you can also call the county tax assessor's office to find out what the rate is in that area so you know for sure how much that's going to be. This would be if there's any rent that was coming in. Down below here we have they're going to be getting a new first loan. They're going to have 2 points that they're going to get. So that's 2% of the $360,000 is going to be $7,200. And again, you would get that from the lender. Hopefully you've been working with a lender and the people have been pre-qualified and know what their loan's going to be. In this particular case, I'm not really spending any time right now, but this would be where you put in prepaid interest, any impounds for property taxes or insurance, and that's typically done. For example, they'll impound for normally either 6 months or a year. In most cases, most people are getting impounded for a year. That's just like it's like a savings account, so that when the tax bill comes due every 6 months, you pay it, or when the insurance bill, property insurance bill comes due once a year, you pay that. That's the whole idea of the impounds. These fees right here are coming from the lender, so you have a processing underwriter fees, a document preparation fee, you have an appraisal fee, funding fees, and again, the lender would know what all of that information is. Here we're making the assumption that the buyer is going to pay the escrow and the title fees. Also notice they're going to pay a lender's title insurance policy, and what that does is it guarantees the lender that they will be in first position, or whatever position they believe they're going to be in, but a new loan would be in first position in the event of a default. And that's what that is. The insurance company is insuring that, and then the title company is charging a fee to do that. Then also on top of that, we would have some document recording fees. Okay. Down below we have other expenses. If we're going to do any kinds of prorations, For example, if we were going to prorate and charge for homeowners dues, that's where that would be. We are putting in this case, just so I can show you how it works, is that in this case we're saying that the buyer is going to pay the documentary transfer tax fees, $1.10 per thousand. So just so you know, just so that you could see how something goes in the form here. If you had a buyer brokerage fee, in this case the seller is paying for the real estate fee, but if you had what's called the buyer, if you were working with a buyer, and the buyer said, no matter what, I will pay you a certain percentage. You go find the property for me. That's what we're talking about. You're going to compensate the buyer's broker. That's where you would put that. In most cases, the seller is paying that fee, but this is just where you could put that if you needed to. Down below here we have an annual insurance premium, excluding the flood and earthquake. So this would be for things like normal homeowners association, not homeowners association, but fire insurance. Okay, that's what this fee, that's $1,200 per year. This would be where we're saying the buyer is going to purchase a home warranty policy. This is the buyer's inspection fee. So if they were paying for the termite inspection, that's where that would be. I'm also putting in here where the buyer is saying they want to have a roof inspection, and the roof inspection would be $150. Also, the homeowners association is going to charge a transfer and or move-in fees. In other words, to essentially do the paperwork to change the accounts over so they go from the old seller's name to the new buyer's name. They charge a fee. Remember, they have to get compensated one way or another. Then these are the total estimated expenses. Going over here on the right side of the form, this would be if they were getting any credits. Okay, in other words, money coming into the transaction that would reduce their costs would go here. This would be the purchase price, less the loans they would be having. They're going to have a total down payment of $90,000, plus the estimated expenses. Remember, we had to know they have to come in with this expense amount. Okay, so the total estimated cash needed that the buyer has to bring into the transaction to close the transaction at escrow is going to be $104,176. This is going to show what the new monthly payment is for just the principal and interest. They have no secondary financing. Their new property taxes are going to be $375. That's a monthly fee based on the new sales price. This is their insurance. Okay. If they were going to have mortgage insurance, in other words, if they were going to be putting down less than 20%, they would normally have a mortgage insurance they would have to pay. That's where that would go. Homeowners dues, this would be just the homeowners dues per month. Here I'm putting in something called Mello-Roos. Mello-Roos is just another bond, just so that you can see how that works. So if we had any other kind of bonds in here, Mello-Roos is something, for example, up where I live, I also pay, in addition to my homeowners dues, I pay Mello-Roos fees. This is my total estimated payment that I would be paying. And of course we go down here, this is where the buyer and the seller sign, the date, again, the name of the real estate company, BRE numbers, Bureau of Real Estate, brokerage numbers and sales numbers go in here. So this gives you an overview of what goes into these forms. Remember, very, very important, that anytime that you have a white area here, that means that you cannot put information in. But on the other hand, if you have a tan area or brown, whatever color, light brown you want to call it, that's where you enter data. So just keep that in mind. And when you look at the form, there's really not a lot of things to fill out. What's important is that you make a list of things and know where all of this information comes from, so that you would be able to give your buyers a very clear picture of how much money they have to put down, what kind of a loan they're going to get, what their costs are going to be, what their monthly payments are going to be, and also how much money they're going to have to bring in at the close of escrow to close the transaction. And this should give you a good idea of what goes in the buyers and the sellers estimated seller's proceeds and estimated buyer cost form, which again, very important. You're the one that's responsible for filling this out. as the real estate agent.